All right, thanks. I hope everyone is appropriately caffeinated. I would like to invite our second panel to come to the stage.
Yeah, he works on
Strategic Partnerships, moderated by our esteemed great friend of the Compact, Erica Pothig. Erica is the Executive Vice President for Strategy and Planning at the Civic Committee and Commercial Club of Chicago. And I will let her introduce the panel, and we look forward to your questions at the end of this one also. Thank you. Thank you. All right, sounds like it's working. Hello, everyone.
Hello.
Hello, hello.
Hello.
I am excited for this conversation. I get to claim a lot of different points on my trajectory, but one of the most important ones along the way has been the Preservation Compact, which I'm proud to say I was able to play an important role at the beginning of the compact.
She's the architect of the Preservation Compact.
So it is amazing to be in this room that is literally almost standing room only, or is standing room only. Thank you, Jack Markowski, for keeping me honest. And be able to have this conversation that brings some important national perspective to the local work. And I'm also proud to say that I'm a member of the Community Investment Corporation Board as well. So let me introduce the panel and the people who are going to help us make that connection between national context and different markets and our work here in Chicago and the Midwest region. So to my left, of course, needs no introduction, is Stacy Young, who was also at the birth of the Preservation Compact and is now the President and CEO of the Community Investment Corporation. Needs no introduction, but pleased to have Stacy bring the perspective here about Chicago. And then to her left is Andrea Brennan, who is the CEO and President of Greater Minnesota Housing Fund. Just one of the premier organizations across the country. I remember when we were crafting some of the early policies in the Preservation Compact, we looked to what was happening in Minnesota, and for decades upon decades, Minnesota has been leading the way in understanding the connections between policy and capital and capacity. So really pleased to have Andrea's perspective on this in this conversation. And then AJ Jackson coming to us from the DC region, but AJ is the president of Leo Capital, Impact Capital, which is a subsidiary of JBG Smith, which I know because they were, I was in a building owned by JBG Smith when I worked for the Urban Institute in DC, and is a really important player in that market. And you're going to hear more about this, about the really extraordinary role they're playing in bringing more capital, their own capital, to affordable rental housing. So you see we have a lot of different perspectives here. We're going to dig in. But I think the first foundational question is for each of our experts to say a bit about the context of the housing market in which they work. Because fortunately, we have some diversity, and I think that's really important, but it's also an important thing to understand when we get to a conversation about partnerships, and so we want to start there. And let me actually start with you, AJ, and have you share more about the kinds of buildings you're working in, the context of the market, anything else you want to share with us so that we understand.
Sure, thanks, and thanks for having me. I think the DC region was highlighted in 3 of the 5 market typologies that were up there. So we cover the waterfront, but Leo Impact Capital, which is a subsidiary of JBG Smith, as Erica mentioned, which is a public REIT in the Washington area, is really focused in what we call high-impact locations, but those are the higher-cost neighborhoods, high-opportunity neighborhoods, similar to what Raphael was talking about, where there is existing stock of unregulated, privately owned housing that's naturally affordable, and we're trying to do preservation there of institutional-scale buildings, which for us means essentially about 100 to 150 units or larger. DC, for those of you who don't know, there were a couple of things going on that got us into this work. One, going back before the pandemic, DC had the highest intensity of gentrification of any market in the United States. And primarily what that meant was wealthier, younger, whiter residents moving into neighborhoods and displacing older, less affluent black residents. And so that was the sort of the organizational context. The other thing that was going on in the DC market is that we had significant growth in our very low income population and our very high income population, and actually Urban did some great research around this, and a decline in our middle income population, primarily due to issues of housing affordability. And as a multi-asset, large landowner in the Washington region, we thought that was a threat to the overall health of the market in the long run and a threat to our business. And so we wanted to figure out how do we organize institutional capital at scale to address housing affordability in ways that preserve affordability, promote economic mobility, but also deliver financial returns so that we can bring more capital and keep the cycle going.
That's terrific. And just maybe a little bit of a follow-up so that folks have some context. I mean, the DC market is more than DC, right?
It is.
And so can you say a little bit about the surrounding communities and for those who are not as familiar? Yeah.
So the interesting thing about DC is it's one market from a housing perspective, but it's 3 states and I don't know how many counties and cities. And so we get the complexity of essentially being a multi-market operator, especially in this space of little a affordable, where we're trying to work in partnership with governments and communities. We get all that complexity as if we're covering coast to coast, but we can do it all from our cars. And so it does create very different levels of public sector engagement, very different market dynamics, and very different levels of authority even that's granted from the state level down to local governments between the District of Columbia proper, Virginia, and Maryland.
Yeah, and as a former resident of Arlington, Virginia, one of those communities out, I remember when Amazon decided to put their headquarters there, that was, I know that you all were in it before then, but that was a big coming together for the community with the 25,000 additional people who were going to be added through that. So, great. Well, thank you for that. Let's go to Minnesota, our Midwest neighbor, and share more about that context, please.
Great. Well, thank you. Glad to be here today. So Greater Minnesota Housing Fund, we are a nonprofit community development financial institution, and we serve the entire state of Minnesota. So our market includes urban areas, so urban core areas, suburban areas, and rural townships and rural communities and tribal communities. So GMHF's NOAA strategy really, we have multiple strategies. I love the framing of this day, by the way, just there is no one size fits all. And so we have developed different NOAA preservation strategies that really speak to some of the challenges in all of those markets. So in urban core markets and suburban markets and in rural markets. And interestingly, what we found is that the strategies that work in some of the urban core areas, just because of the size of the NOAA property being a smaller, much smaller scale, older properties, very similar to those properties in rural communities as well. The old main streets in rural America. So we're finding some of those similarities in our NOAA preservation strategies. And then with the suburban strategies being more larger buildings and then like more 1960s, 1970s era that lend itself to larger sort of scale operations. So I would say too about Minnesota generally, the Twin Cities metropolitan area is about 60% of the state's population. So most of more folks live in the Minneapolis-St. Paul metropolitan area than the rest of the state, and that metropolitan area has experienced, they're not immune to the challenges of gentrification for sure in the urban core areas. And I also just wanted to give a plug to just the land use policy, which has been very effective in Minnesota in really encouraging more production, which has kept rent increases lower than a lot of our peer cities around the country. That said, that has not that has not diminished the need to preserve NOAA property. So even in a very aggressive production, policy environment, what we have found is that the NOAA preservation, we can't build our way out of it. Even if we are getting a lot of production, we still need really strong NOAA preservation efforts.
So did people watch the vice president debate last night? Okay. Governor Walz, did people remember this? Okay. What percentage of increase in supply as a result of the policies? Do people remember? 12%. Okay. And then that led to a growth or decline in cost by 4%. Good. All right. Excellent. Is that, or were those the policies you were referencing? Yeah, the single-family zoning. Yeah.
Absolutely, and the policies around single-family zoning that just got most of the attention.
Yeah.
A lot of it was that missing middle, so it really allowed more as-of-right development of that missing middle, which is really what a lot of NOAA property is.
Yeah.
So it's bringing back, it's allowing for the new construction of what we now consider to be NOAA property.
Great.
So there's definitely a very strong relationship between the two.
Terrific. Okay, Stacy, tell us what we should know but don't already know, or maybe know, and you're going to give it an additional twist about the Chicago regional market.
So I'll talk about CIC's work in the Chicago regional market. I mean, Steve already did a beautiful job describing what we do, so thank you, Steve. But CIC was created, which is about partnerships, this panel, by a group of investors, of banks who said the historically disinvested neighborhoods in Chicago need to have access to capital so that those local owner-operators can buy and rehab these existing buildings that we have in those neighborhoods. And so historically, those are the neighborhoods where CIC has done most of its financing, the historically disinvested neighborhoods in Chicago, on the south side, on the west side is where a lot of our work is. That being said, we certainly work throughout the region. And then we also are typically doing acquisition rehab financing for small multifamily, when I say small, 6 to 50 units. And that's primarily what we're up to now. Given the spirit, the name of this is called Breaking Up the NOAA Monolith. Well, we have broken it at CIC. We are basically a pile of rocks because in addition to having those disinvested markets as where we do our lending, we also created a fund based on hearing from our partners and collaborators to create affordability in higher cost markets. And that is a different kind of preservation financing tool. In the Great Recession in 2009, 10, and 11, we created a fund, even though we typically are on the multifamily side, to do some preservation of the 1 to 4 stock. And so this is kind of, we have been really attuned to this for a while, which is NOAA is a lot of things. It's different things in different markets, and we need different tools to address those different types of stock in those different types of markets. In addition, CIC has recognized the importance of the support that the small and medium-sized local owner-operators, those are our borrowers, the support that they need. So we have a property management training program, shout out to Erica, sitting right over there, who runs that program. We also have a direct intervention, an arm that does direct interventions in partnerships with the City of Chicago, the Troubled Buildings Initiative. Jonah, I thought I saw Jonah here a little while ago, but and of course the Preservation Compact. And so the idea is we have financing as our seat of our stool, but to support that, we have capacity building with property management training. We have a policy collaborative creating a supportive framework for preservation of NOAA, and we have these direct property interventions.
Great, okay. So this is a panel about partnerships. So I want to unpack more about who your partners are. And I want to start with who are the usual suspects? Like who might be, say a little bit more about who we might expect would be your partners, and what's the characteristic of that partnership? And then I'm going to ask you to reflect on the unusual suspects that are your partners. And so let me start with you, Stacy. Say a little bit more about like your core model and how it began. 50 years old now. How that began, because it is quite unusual. There are not many examples of CICs across the country, and I think that might be something uniquely about Chicago, but tell us more about who your core partners are.
So our core partners are our investors are banks, and big shout out to lots of bank investors from CIC I see here today, and thank you for your support over the last 50 years. It is our 50th anniversary. Please come to our special event in December. You'll be receiving many emails in the future. So those banks, like I said, they got together 50 years ago and said we need to provide access to capital. And so they created a shared risk pool model so that a bunch of banks are in this together. They commit money to us. They have $330 million that they have committed to us. We originate loans, and then we sell those notes to those investors who committed money to us. And that's a lovely thing, right? It means that we can stay liquid, we sell our notes, we get more money, we make more loans. It's also nice because we're good stewards of the money, if I do say so myself. We're making good loans thanks to great lenders in the room. I see Phil and Roz and maybe some others. So we do a good job making loans. We also have a very solid loan loss reserve. We have a first investor loss fund. We have not passed losses along to investors in the past 3 or 4 decades, which is pretty great. So it's a great model in that we are passing along returns to our investors. We are protecting our investors by making prudent loans. And we are helping the neighborhoods by providing access to capital, not just to improve the buildings, but through these small owner-operators, many of whom maybe they're getting their first loan from CIC. We did a survey last year. 60% of our borrowers are led by people of color, 20% are led by women. And this is, these are the small businesses, the for-profit businesses, as Steve was describing earlier, who own 70% of our affordable rental housing, and we need to support them. So thanks to those investors, we have been able to create that access to capital to keep those buildings in good condition and help these small businesses grow and create generational wealth.
And what's interesting to me is a lot's changed in banking over the last 50 years. And with mergers and acquisitions and consolidations, and yet you've still be able to sustain this level of engagement in the core pool. So let me go to you. We're talking about usual suspects and the characteristic of that relationship with people we might and institutions we might expect to be part of your strategy.
Sure. I would just echo what Stacey's saying. A lot of our usual suspect partners are banks, banking institutions that, and we've had a couple of different approaches to our NOAA tools. One is an equity approach, so banks being part of an equity structured fund, and then also a lending strategy. And also then, in that case, banks can make loans to us as an organization, and then we then in turn, blend that funding with other funding to provide lower cost capital debt as well. So banks are really key, accessing private bank capital, but it's not enough. And so our business model is really to blend that private bank capital with other capital that is lower cost, like grants. We've been fortunate to receive grant funds from the CDFI fund for the last number of years. That's been really helpful to create a blended lower cost of capital. And then on the equity side, we've been creative in blending that bank capital with some public funding as well as philanthropy.
Okay, so AJ, tell us now, I'm going to invite you to say, you're a REIT, who are the people we might expect, but also give us a bit of the story about some of what's unusual about your approach?
Yeah, so when we were looking around at the housing affordability landscape, as I mentioned earlier, saying where can we be additive here, we have a lot of high capacity, low-income housing tax credit nonprofit developers in the Washington region. We saw a need in the middle income space for 60 to 120% of AMI. We saw a need for NOAA preservation. We didn't see capital and structure organized around that. And so we raised a fund to provide capital to nonprofit and other mission-aligned sponsors to go out and acquire those buildings, institutional scale buildings in these neighborhoods. And as Raphael said, convert them to committed affordable housing. We restrict affordable in the units, we have long-term affordability, we do income certification, et cetera. So the first sort of set of partners there, usual/unusual suspects, are the nonprofits. But what we realized at the beginning is there weren't a lot of nonprofits who were focused on middle income, and there weren't a lot, to the point you made, Erica, earlier, who were focused regionally, right? They're very strong just in the District of Columbia or just in one neighborhood in Northern Virginia, but not regionally. And so we actually partnered with a local civic group called the Federal City Council to create a new nonprofit that they incubated that's independent of us, that has its own board, called the Washington Housing Conservancy, with the exclusive focus of acquiring essentially middle-income housing across the region. And so that was a very important partnership, bringing in other real estate developers, other business leaders outside of our orbit to stand up that nonprofit partner. Within the fund, like everyone's mentioned, we have a lot of bank investors who are members of our fund. We also have some corporate partners, as well as some high net worth individuals who are members of our fund. I think Raphael and I were separated at birth, because he kind of said earlier, where we don't have a lot of engagement is with the traditional philanthropic sector from foundations. And we do try to make returns on capital, so we make too much money to be a PRI, but we don't make enough money to be in the corpus, because we're not seeking opportunistic returns like a lot of the value-add competitors that we have.
You have your own capital, right?
And we have our own capital, so we're investors in the fund, but then the key to us was really to raise this pool. It's largely third-party capital. Raise this pool of purely discretionary money that we manage and control, so that we can move at the speed of the market, and so that we can do things with more flexibility than public dollars, right? So we can provide very high leverage, we can make equity investments, we can structure our investments so that they're variable payments based on cash flow as opposed to fixed loan payments. We can defer a portion. We do all sorts of things to make it possible for mission sponsors to acquire and operate these properties. And then the other thing that we provide, because we are a large public real estate company, is we provide our real estate infrastructure to those borrowers. We don't do third-party management generally. We don't do third-party development generally, but for our mission sponsors, we utilize our asset management platform, our property operations platform, our sustainability platform, our capital project platform, to help them own and operate these properties that they otherwise don't be able to. So just they're larger and at a different level. I mean, I think we have assets as big as 825 units.
So that's super helpful. So, Andrea, you mentioned, philanthropy is often a partner in the capital stack in many of these funds, right? But give us a little bit of perspective on the ways in which that more usual partner is doing more unusual things in that partnership, and what that looks like.
Sure. We've had a long-term relationship. We were actually founded by two foundations in Minnesota. So we were founded by philanthropy, and this really is our origin story, and our origin story for getting into NOAA. We were charged at our creation 27 years ago with really tending to the ecosystem in housing in Minnesota. So where there are needs, where there are gaps in the system, we step in, and whether it's research development, creating new tools, et cetera, that's where we operate. So in this case, in creating our NOAA Equity Fund, we had conversations and were successful in getting a contribution from a local foundation, and that local foundation actually did invest from their corpus, so they had very high return expectations on that. At the same time, they were willing to give an equal amount, so it's a $2 million investment from the corpus, and then another $2 million guarantee, unfunded guarantee. But the idea, and this is, there's a lot of learning that goes into creating these structures, and also, you know, a lot of having to move very quickly to adjust to whatever is happening in the marketplace. And so originally, this foundation offered up a $2 million unfunded guarantee, hoping that we could get lower cost main capital, and that just didn't really work out that well. But what it did is it allowed us to invest more of our equity into this fund, and so we were able to invest more of our equity into this fund with that guarantee. And now, one of the ways that the foundation sort of justified this is that the return on the, you know, and the way that this fund is structured, there's different classes, so A, B, C, D, et cetera. And so the higher the class, the first year repaid. And so that class would be in the higher realm, so very likely to get repaid and to get those returns. So the idea is that even if there is a call on that guarantee, there's enough return on that investment that they would basically not have to fund it from out of pocket, because they would be able to use the returns that they're getting from that investment to basically fund their guarantee if it's called. So that's for us, it was a very creative and new way of partnering with local philanthropy.
No, I'm glad you raised the point about the corpus too, because I think many have tried to figure out how to tap into that. And to your point about like the return expectations, may or may not fit with the strategy. So, Stacy, one of the things the Preservation Compact has really led on and been the national model is the very innovative policy solutions you've developed that you alluded to. So, I want you to talk about that in relationship to what are some of those unusual ways that the Preservation Compact, the Chicago partners, many of whom are in this room, have created some of those tools that show up in NOAA preservation.
Thanks for the question, Erica. So over the years, you know, CIC has been a very dependable, reliable source of capital, as I said before. Again, multifamily in the historically disinvested markets. And you know, when the Preservation Compact, and has done different little programs along the way, when the Preservation Compact came around about 15 years ago, bringing all these different stakeholders together, and I see many around the room, over the years we've worked together to really identify, you said this, gaps in the marketplace, right? So where are there gaps and how can we fill those gaps? And so, you know, many things came up. Our public partners helped us along the way, you know, by providing, for instance, you know, top loss capital. We created this fund really targeted to higher cost markets, a mezzanine debt fund, because we heard from our partners in the Preservation Compact, there are some great tools in these disinvested markets, but we need to create affordability in the efficient way that CIC knows how to create affordability, not by using all this public subsidy, but by just providing debt. And that was what we did. So we used some a grant from the city as our top loss, and that then helped attract the private capital. That is a great way to use public money and a great way to fill a gap in a very efficient way so that private owners in these higher cost markets can use this mezzanine debt, low cost mezz debt, buy the building, keep a portion affordable, but it's bringing partners to the table to identify the gap, partners to the table to bring the capital in, and then making sure that it's running efficiently, and CIC has been, you know, running that. There's a lot of other things too. So the one way that the public sector has been useful, aside, again, lots of things, right? As a CDFI, we can leverage those dollars in a way that others can't. We have a really great program that targets preserving single room occupancy buildings, SROs. Whereas a CDFI, we provide more financing than we normally would because these buildings need a little more rehab than other buildings. And then when the construction is done, a city grant comes in and pays off that delta between what we can finance in our first mortgage and what the building really needed in terms of rehab. So there are a lot of examples. Another example of the public sector leadership here is not necessarily bringing money to the table, although we love that, if we can be efficient about it, as I just said. But one thing is using the bully pulpit, and we administer a program for the city called the Woodlawn Construction Loan Fund, and the city brought lenders to the table in 2018-19 and said, we need your extremely low-cost money to help create this fund in order to provide low-cost construction. And so there's no city money in that fund, but banks stepped forward, some of them are in this room, thank you, with 1% program-related investments, and now we can use that. So there's so many ways where partners come together, define the gap in the marketplace, say here's a need, and then public sector, maybe foundation can help to leverage the private capital to make it happen. And again, as a CDFI, we can do that pretty efficiently.
And it's a real credit to the many public sector partners at different levels for being along this journey and being willing to use their tools in different kinds of ways. That, having had a national perspective, that is not usual. And so we're gonna ask the last question, which is my invitation to you to start to think about your questions, and we're gonna go to that in a minute. But AJ, we had an opportunity, on the pre-call to say, okay, yeah, how is the public sector engaged? What are some of your obstacles in doing your work? And can you say a little bit more about the challenges you face in your particular market?
Yeah, the biggest challenge that we face, and maybe of Stacy here, is that it goes back to this 3 states and multiple jurisdictions. Public sector dollars are generally ring-fenced to the jurisdiction that they come from. And so each of those markets is not big enough for us to create a siloed investment vehicle just for Montgomery County or even just for Washington, D.C. Collectively, the market is 4.5 million people, but each one is small. So we don't really have any public sector investment, and it's hard to attract. However, the one place where we have a lot of public sector engagement and that we think is a really powerful tool is on the tax relief side, where we can structure tax abatement in exchange for committed affordability of properties. And the biggest effort that we are engaged in on an ongoing basis is to make those commitments predictable, formulaic, and underwritable. Because we're not doing public projects that have 2-year development timelines and 6 months to close, and we can negotiate everything. We're out competing with people who want to put granite countertops and stainless steel apartments and raise the rent $200. We've got 60 to 45 days to lock it up, and then we've got another 30 days to close. And we need to have our first mortgage financing in place by the end of our diligence period, so 45 to 60 days. The first mortgage lender, which is generally for us, Fannie Mae or Freddie Mac, is not going to underwrite an abatement that's not predictable and formulaic. So extreme example, in one case, we actually had to buy a building, $30 million investment on our line of credit, because Freddie Mac couldn't get comfortable with the tax abatement because the county wouldn't do it in a formulaic way. We knew we would get it, so we were able to then place the first mortgage 65 days later. Most people don't have that ability, and that's not really a solution, right? That's something we're able to do, but that's not really a solution. So that's where we engage a lot with the public sector, is trying to make the things that they want to do predictable and formulaic, so that in this unregulated NOAA space we can move and speak to the market.
Great insight. So we've really been through quite a traumatic time in the last couple of years, which has, in many respects, elevated the importance of housing, which has always been unaffordable for a core part of our American residents of the U.S., but has only grown too. And I'd love you, maybe Stacey, to reflect on COVID and what that did to the market, to your partnerships too, with your owners, with your investors, with your borrowers. What did you learn through that particular experience that maybe is helping you reflect on what you do going forward?
Well, I think Steve in the last panel said this is not for the faint of heart, and I think that is partially, whether you're a nonprofit or for-profit, really just that mission motivation is so important. So we closed our equity fund in 2017, so a lot of the properties that were purchased under that fund were, purchased at a high price, and then on the small NOAA lending products that we have, basically in both our equity and our debt NOAA work, nothing has performed as it was projected to perform. And I don't think that any of us could have foreseen the economic headwinds that we'll be facing rental property ownership in the last number of years. I think the last panel did a good job of highlighting those operating increases, inflation, interest rate, like everything, you name it. And so what we've done is, number one, that's the importance on the equity side, just really stress testing, and we have reserves, and we're in it for the long haul. And so even though the portfolio is underperforming right now, it continues to get better and better and better. We do, annual financial forecasting updates based on actuals for the last year, and we go in and we do property physical assessments and all of that. And so really just, this is not we think that things will be turning around in this portfolio. It just will take a little bit of time. On the smaller NOAA front, where we're working with smaller owner-operators, it's a lot of technical assistance. So on our lending side, we've made first mortgage loans for some of these properties, and we've sold those loans to our state housing finance agency or to the CDFI fund, and we've bought them back so that we can do workouts with the owners. We've done a lot of debt restructure, we've done a lot of technical assistance, we've brought in a lot of pro bono professional services with property management, accounting. We've done fiscal needs assessments on some of these properties to help really just get them back on track. So it's definitely been extremely active. We've grown our asset management function as an organization so that we can really provide the kind of support that's needed to make sure that ultimately these properties are successful. It's not, because it's important to everybody. It's important to residents first and foremost. It's important to the communities where these properties are located. It's important to funders, of course, too. No one wants to lose money, but at the end of the day, it's really about the people, the residents, and the neighborhoods.
Great, thank you.
Same. So this is why Andrea and I are best friends. So, on the lending side, definitely, COVID hit and we were like, ooh, I'm not sure how much more lending we're doing. But then we did open our doors again, right? Which is how we make sure that these buildings stay in good shape, how we make sure that the borrowers get access to capital. Everything that Andrea said about asset management. I will say, let's talk about supporting the borrowers for a minute, our clients. The Preservation Compact, when all of this emergency rental assistance came down the pike, we got the state HFA, the city of Chicago, Cook County together, and we said, let's all learn from each other. You guys cannot do this alone. But I would say, and huge kudos to Emily Bloom-Carlin, who created a website and did all sorts of incredibly useful things to ensure that there was a one-stop shop resource. But one of the things that I think we did was most important was introducing, sometimes for the first time, the NOAA owners, the NOAA borrowers to the public agencies, right? The public agencies know the big A LIHTC developers well. They really didn't know. They'd known from meetings that they had with us, but now they had to serve these owners, these folks, with that emergency rental assistance money. And so for us to be able to say, let's talk to them. What do they need? What is going to be the best way to reach them with this money? And that was some value we could bring to the table, as it relates to the emergency rental assistance. But I would also say, we are out there lending. One of the things about CIC is we are there lending. We're not out with a vengeance, and then we stop lending. And we are out there and reliable and ready to serve our clients in the neighborhoods.
Wow, some fantastic observations, and I want to go to our audience now for your questions and reflections too. Yes, and please introduce yourself when you pose your question.
Stephen, you get started, but I'm going to come with the microphone, but don't wait for me. My name is Stephen Vance. I run a company called Chicago Cityscape. So question is for Stacy and for AJ. So Stacy, you said that your bank partners step forward. And AJ, you said well, you didn't say the word step forward, but you mentioned high net worth individuals. What compels banks and high net worth individuals to step forward and participate in these collaborative lending pools?
Obviously, it's great leadership. There's something called the Community Reinvestment Act, which is a great framework for the banks to, feel inspired to make investments and commitments. I will also say that, our investors, they are committed. And, they're looking at each other and they enthusiastically recruit other investors. I mean, it's a true partnership. And so, yes, CRA is important, but honestly, we've got a strong track record. They trust us. They think we're reliable. And so, they go out and they ask other banks to come in and invest as well.
Yeah, so we were able to leverage the JBD Smith corporate banking relationships. Obviously, CRA is important, but when we were raising a new discretionary commingled fund, it's not a loan pool, they don't participate in individual loans, they don't buy them back, we hold them, they get returns. It's a private equity fund, essentially. And getting CRA motivated banks to invest in a mezzanine private equity fund was a lot of work. It was a lot of work. But we started with our big corporate banking relationships, who are also some of the largest banks, and we spent a lot of time educating and working with them, and then they were able to go out and help bring others into the fold. I think the biggest challenge that we had was that we were not doing LIHTC. And so it was better to have a commercial banker who knew nothing about affordable housing than someone from the community development bank who kept asking us why we weren't doing this and that around income certification and what about basis and all this stuff that doesn't really matter in this space, and trying to figure out how it was un-LIHTC as opposed to starting from scratch. But it probably took us a year to get the first two big banks on board, and then they brought in others. And for the high net worth individuals, it's a combination of, we are trying to generate return. It's not a charitable contribution. It's a combination of the return, but also the investment in the local community, right? I mean, everyone can see what's going on in terms of displacement. Everyone can see what's going on in terms of gentrification. I think there's a group of individuals who would like to, be a part of a solution that they feel like is scalable and replicable, and is not asking them to just give money away.
And I have a quick additional comment, which is for banks who don't know about NOAA, we're talking about NOAA today, and they're thinking about CRA and they're thinking about affordable housing, the regulators get confused. The regulators think affordable housing means you have to have a tenant income certification, you have to have all these things that have come with big A, LIHTC, big subsidized buildings, and you really have to educate those regulators and the banks, if they're not familiar with NOAA investments, that this is real affordable rental housing, and you're not going to have those same, miles of paperwork that you have on the LIHTC side.
So can you I want to push on that a little bit more. We were talking about like the OCC, the Federal Reserve, the FDIC. Yeah,
that's right.
Yeah,
and so they're the ones who are saying to the banks, we want you to do CRA. But if they go and do one of their exams, they're like, what is this? Where are the tenant income certifications? Where's all the stuff that I see with low-income housing tax credit deals? And this is a challenge. We're raising up NOAA as an important investment now. And I think if banks continue, we have to make sure that banks continue to be good partners, and that means also educating the regulators.
That's a good, that's what I just double down. That's a really good point. One of the other things that we did, in addition to working with these banks, is we went proactively, submitted our PPM, our fund documents, to the OCC, and said, would you tell us if this is a CRA qualified investment? And they're only one of the three regulators, and our banks are regulated in multiple jurisdictions, so actually there's 36 or whatever, there's 12 jurisdictions, 36 regulators effectively, but that OCC stamp of certification, in addition to having a couple of really name brand kind of top three banks, was essential to getting others to come in. Because if you're a small bank and you don't have that depth of expertise on staff, you just go by tax credits, pass, right? It's too much work.
Super smart. Because you're helping your banks in that, right? You're getting them comfortable by doing the work with the regulators. Okay, so I have a question back here, yeah.
Hi, John Womack from Third City Properties, for-profit owner manager on the northwest side of Chicago. In terms of strategic partners, elected officials are crafting legislation. To what extent are elected officials a strategic partner across each of your geographies? Where does it work well? What are the challenges? Where does it not work well?
Well, you have a really important one right now, who seems to be promoting your work. You want to try to take that?
Sure, I would say that, especially in the NOAA preservation space, our public partners have been really important in really making things work. And AJ described the challenges of just like the multiple jurisdictions and how you pair that dollar with the geography, and that can be a challenge. And what we have found is that we do more deals in jurisdictions where the public sector is also contributing in some way, shape, or form, whether they're contributing to our fund or whether they have their own fund that can be paired with ours. Particularly in parts of the city and parts of the metropolitan area that have higher property values. It's really hard to compete with some of the value-add investors without really bringing in some lower cost capital that, just the public sector being involved in that has been really critical. The other thing in Minnesota is that we have a statewide legislation that allows for a lower property tax class rate for affordable housing, including NOAA, as long as it's NOAA converted to affordable with some kind of deed restriction on income and rent restrictions, even for a portion of the unit. So that has been really helpful as well. I would say those two, bringing funding to the table and tax treatment have been really helpful. On the policy side, I think that there hasn't been a lot of, I can't really point to a policy that I think has been overly effective off the top of my head.
So I hesitated about elected officials. What I will not hesitate about, and again, we have great elected officials here in Chicago, state of Illinois, but I have seen the leadership come from the staff at the city of Chicago and the state agencies, and so thank you. I know some of these folks are here today, but also, the assessor's office, the assessor's office, the city, they were right there with us when we were trying to pass this legislation for the property tax incentive that you've heard from a couple of folks up here. And that's a really, AJ said it all, to have a predictable source of property tax relief where I made this investment, I'm holding these units affordable, and therefore I will get this break on my property taxes. That's really important. We've got the assessor's office here today too, so kudos to the leadership there. But I don't want, when we talk about elected officials, I don't want to short shrift. Public sector support and incredibly helpful, supportive staff at these agencies, it's so important.
Agree 100%.
I would say, I think where we get the most support from elected officials is those who are willing to push the debate. It's a both and, not a either or, between this NOAA space and little a and the capital A affordable. Because a lot of times we have to break through the, why aren't you doing more, low-income housing, why aren't you doing permanent supportive housing? We need all of those things, but it's a both and, and that's where the political leadership can really be valuable to create the space to say, we got to look at the spectrum of housing.
Great question. Yes. Hi. Well, start talking and she's bringing them in.
My name is Dorothy Hester and I'm a community organizer with my north side, and I have a question about affordability. I heard someone just now mention the capital A versus the small a in affordability. When we're talking about NOAA housing, what percent, so my understanding is that more than 30% of our income would keep us cost burden in housing, right? what is the AMI that we consider to base affordable housing on, and especially in a city like Chicago?
Do you want to start with that?
I mean, I'll just say that there's such a big, you know, we can talk about area median income, and I appreciate, thank you for coming to right away. And we can talk about, you know, when we say NOAA, what we mean when we say, you know, affordable. Sometimes we're talking about comparatively affordable, right? And I think Maggie said this at the top. You know, naturally occurring means that you've got affordability. When I say 70% of, you know, the affordable rental in the United States is unsubsidized, that is looking at a level at 80%. And, you know, when we talk about CIC and what we're financing, nearly 90% of what we finance, the rents are affordable at 60%. But all that to say, all these percentages don't mean a thing when you're earning $10,000 a year, when you're earning $15,000 a year. Because for those extremely low-income people, and there are way too many of them, who cannot afford rents, 60%, 50%, it doesn't matter. They don't earn enough money to pay market rents. And for that, you need rental assistance. You need rental subsidies like housing choice vouchers, project-based vouchers, the low-income housing trust fund. I know Anise is here somewhere. I think it's really important to realize, you know, the housing and the rents and how you need to pay your operating costs as an owner and what's affordable, you know, without subsidy is a very different conversation than extremely low-income people who don't earn enough money to pay anything. They need rental assistance.
So what is it, 70%? Is that what you're saying for NOAA housing?
Well, it's about, so, you know, we could look at different numbers. Like I said, at CIC, 90% of what we're financing is affordable at 60% of AMI.
But
I think maybe one thing I would add to that is I understand through you, like the property management training that you provide, one of the things you do is educate people about the voucher program. So, you know, vouchers are a form of assistance that can be utilized otherwise in many of the properties that you finance, right? Yeah.
In fact, if I could just jump in on that one too, when we provide financing for NOAA preservation, I mean, that's a requirement, is that, you know, property owners can't discriminate based on source of income. So they can't discriminate based on whether or not someone has a subsidy, whether it be housing, you know, Section 8 housing choice vouchers or other types of rental subsidy. And so it's the, you know, there may be an affordability limit, you know, in our case, a lot of times it's 60% AMI on a certain, like half of the units at least. But then in addition to that, it's also, you know, bringing in other requirements and incentives to accept those rental subsidies so that we can definitely serve and support lower income households beyond, like that have income way below the 60% of area median income. Additionally, because the financing is, you know, it costs less, and so it takes more pressure off of the need to raise rents, and so it also keeps rent increases at a much lower annual rate as well.
Great, we have one question over here.
One final question. Thank you.
Urban equities. I'd like to take us 10,000 feet for a second as we get ready to close, right? So we've got an election coming up in about 30 days or so. And I'm curious to know if each of you kind of heard something. Did you say, a strategic opportunity awaits us? Irrespective of candidate, if there would be one thing that you've heard, what would that be?
Okay, great last question. Let's go down. AJ, let's come this way.
Yeah, I do think there's strategic opportunity because the things that I've heard that are really exciting to me are let's rapidly increase the supply of housing and let's understand the link between supply and affordability and the need for affordability, not just affordable housing, but affordability at all sorts of different incomes. So that to me creates a lot of opportunity for policy action.
In addition, I would add that I think that there's growing awareness across America, not just in like the blue cities, but in a lot of rural communities, that affordable housing, access to affordable housing, whether it's existing housing or new supply of housing, is an economic development issue. And I think that You know, in addition to what we're hearing from the presidential candidates, I think that there's growing, you know, we're starting to hear a lot more from members of Congress that, you know, that there's potential for the federal government to get back into the housing game in a much more meaningful way than they have been since the 1980s.
I echo what these guys said. Also, I do think people are starting to realize that we need regulations for some things, and maybe we don't need them as many as we have. And so I think lifting some of those regulatory, you know, extremely burdensome regulatory frameworks locally and federally, you know, if we're smart about it, that could go a long way too.
Well, please join me in thanking this incredible panel for providing